Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So you can see that trend lasted really for about a month and a half. Actually, Steve and I had done a webinar together where I said, we were going a lot lower on the U.S. dollar against the Canadian. This is, remember what we said, the CDD you've got up here in the top left. These charts are pulled off a TradeStation, which is just one of many platforms that you can use this on. But basically, you see that we get that long trend to the downside, and then once we start breaking back above that, you can see we actually did a pretty good flip in reverse, and actually on the second close outside of there, just barely closed outside of the second day back here in mid-November, you had now a short-term uptrend signal. So one of the things that technical analysis lets you do with indicators like this is that it prevents you from kind of getting caught up in the media storm and the buzz about, the dollar is such a disaster in November. Well, of course, it was a disaster, but most people are what I call hindsight traders. They're rearview mirror traders. They look backwards and try to then extrapolate going forwards. But what these indicators allow you to do is to see when the trend changes significantly enough that you have to change with it and adapt with it, and then you can get on the other side. And then, of course, other traders are still adapting, and there's still more meat on the bone, more opportunity in those kind of examples. And if it's wrong, if it's gonna break down, not just under the bands, we tend to use some other trailing stop techniques like the %R, which I'm going to talk about. But that bands is the first thrust, that first sort of rocket takeoff point to the upside or the downside to get that first acceleration. You think about the analogy of a rocket. Where does most of the energy get used with a rocket or the space shuttle? It's right at the point of takeoff. That it's coming from basically a moment of inertia, we call it. It's not moving. It's got to get off the ground, away from Earth's gravitational force, and the only way to really do that is with enough thrust to get it up into orbit, and then those boosters peel off. Well, it's the same idea here. If it doesn't get enough thrust, if it tries like in mid-August and fails, it comes back to Earth. It comes back into the bands. Versus if it really starts to bust out for more than that one bar, but that second bar, you can get a nice extension of that. So,
Bryce, can I interject for 1 second? Can you go back to that slide? I don't know exactly when you were on, during that break, but everyone can go and listen to the podcast. I think we've released it, although I'm not positive. I asked Price, and I'm not sure if it was mid-October, early November. My guess, it was trading around 97. I said, Price, come on, don't you think it's oversold here? And you can go listen to this podcast. He said, Steve, it's strange, because I remember what he said, but he goes, I think it's going to go quite a bit lower. And Price, could you pull that up? Can you just put a little bar on, let's say, where it looked pretty over, at least in my mind, 97-ish?
Right when we got in this little bit of a bounce here back in about mid-October, and that was kind of coming right back into a retest area with our %R.
Exactly right.
About in a minute, and we were saying that's where the bulls will take a shot to say, hey, this thing looks a little washed out. Maybe we can rally this thing, and then if it's just kind of a weak little bounce, we tend to see those bounces get rejected pretty firmly, and you get another big leg down. So, as Steve notes, we did note, hey, watch out. There's still more potential here, and of course, you got that.
It's an awesome call. An absolute awesome call.
And that's what you're looking for. It's just that kind of a quick pop. You can see eventually it reverse, but we have some rules of thumb where we'll take some money off the table and try to get to a free trade position, which we'll talk about, and then basically at that point you can follow your stop rules, take it out. Even if you leave a little bit of profit on the table, you've gotten your risk out of the trade. So I appreciate that, Steve. Yeah, I mean it was fun to make that call, and definitely. But again, it's not about anticipating the next move. It's about saying where are we right now, and so we'll come back to that in a second after I lay this other groundwork here. So. Williams %R, you can get this indicator, whereas acceleration bands is something I created that's proprietary to big trends. That Williams %R you should be able to find on just about any major platform as Steve mentioned on one of the earlier charts we had, like Big Charts or Yahoo or any of those major charting platforms, you should be able to find it. The whole idea that when Larry Williams came up with it was he was looking to find those overbought or oversold levels. But I'm sure you've all noticed it where when you see those big trends where a stock goes overbought and then it just keeps going up, you're like, well, why is that happening? If it's overbought, it's not supposed to go up anymore, is it? And you ask yourself that, and you're like, well, why am I missing those moves? And so that's where we have a situation where we're really trying to, say, when do we get an unusual trend? Now, based on testing, a lot of places will default you to a 10 or a 14-bar setting, but I found based on testing that 30 bars is the key. Now, I had one of my coaching clients who said, well, you're always talking about bars, what are we drinking here? And I said, no, we're just talking about intervals, what time period we're talking about. And so if we're on a daily chart, that's the last 30 days. If we're on an hourly chart, that's the last 30 hours. If we're on a weekly chart, so about a half year or the last 30 weeks. So, I don't change my time frame, my settings around between time frames. I always keep it, in this case, at the 30 bars because it tests so well across all these different time frames. So how does this work? Well, again, and this assumes you're using a 0 to 100 percentile scale. Actually, Williams originally used a strange scale of minus 100 at the low up to 0 at the high. But, the principles are still the same. You're looking for the top 20% of moves when it goes, as I put in quotes here, overbought. Why do I put that in quotes? Because it's actually the unusual, the unconventional thing that I'm looking for where we make the best money on our trades. And that's where it goes overbought and stays overbought. And if you think about it, if you were at the top of the trading range, you just went overbought. In this case, I grade that based on testing above the 80 percentile level into the top 20% of readings. So it's saying, okay, it's overbought. Well, if it was truly the top of the trading range, what should happen? It should flatten out or start coming back down. So what shouldn't happen? And this is important for you to ask yourself in your trades, both what you expect to happen and what shouldn't happen. And sometimes what shouldn't happen when it's doing what you don't expect, those can be some of the most powerful trades the other way. And so not only should you stop yourself out, but you should be, in this case, prepared to say, hey, something unusual is happening here. There's an opportunity in that surprise, that unexpected event. So in this case, these unexpected situations where you get a close, not an intraday trade, but a close above that first overbought bar's high. So the close is the key word there. It's got to close above that first overbought bar's high. It tells me that, okay, it's not the top of the trading range. In fact, it's the start. I call that the bull confirmation signal. It's the start of an unusually bullish trend. And then we'll talk about how we get some tests along the way for low-risk entries, too. On the bear side, it's just the opposite. Now we're looking for the quote-unquote oversold readings in the bottom 20th percentile. And then that bar's low shouldn't get violated, should it, if it's going to be the bottom of the trading range. In fact, if we get a close under that bar's low, that tells me that something bad is coming, still to come. You're never going to catch the exact high and low, and you shouldn't try to. That I remember John Bollinger once at a conference saying that one of his mentors once told him that you're allowed to catch the exact high and low once in your lifetime of trading, and it's true. How many times have you tried to catch that exact low or that exact high and yet gotten roasted or looked back and said, man, if I just followed more of a rules-based approach, I'd have caught the meat of the move or avoided that drawdown phase. And that's one of the goals I try to teach traders of big trends and teach you all here tonight as well, is that basically a big part of this is about risk management. It's not just about finding the winner, but it's also about how do you get out, how do you manage the trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.